I'm Fran.
I'm Danielle.
These are our coffees.
Come on, Mike.
And I'm Mike.
Yeah. I'm Fran.
I'm Danielle.
These are
Oh
my God!
I thought
I'm Fran.
I'm Danielle.
These are our
No,
Mike! Yeah, you were close.
We'll just stop ourselves.
Okay.
Yeah. Don't you worry. I'm Fran.
I'm Danielle.
As soon as we'll do it one more time. This is it. I'm Fran.
I'm Danielle.
These
I'm Mike.
Oh wow! It's Mike from First World Mortgage. Hold on, we'll get you a chair. Now that we've got our coffees and we've got Mike here, we're gonna have a little show about lending, I suppose, right? Since this guy popped in.
Yeah, we brought in the pros today.
So our friend Mike here is from First World Mortgage. And why don't we start with Mike telling us a little bit about himself. First of all, my first question is, because Mike's name is Mike House. So my first question is, did you always know that you wanted to do something with houses in the name, or is this something that just happened?
Yeah, actually, I've been into the houses and real estate and things like that since I was young. I got the course on flipping houses when I was a teenager, and I was a realtor, real estate investor, mortgage officer. So I've always done things along the lines of my last name, which is convenient.
I bet it is.
So
So
marketing is
you've
great.
been doing this for a long time and doing a lot of different, like you've worn a lot of hats.
Yep.
That's cool.
Mm-hmm.
Danielle, do you have any questions for Mike over here?
Yeah. So can you tell me the basics of what the mortgage process looks like?
Sure. So the basics of the mortgage process, I mean, when someone decides that they're going to apply for a mortgage, they need to submit an application with the lender, which is just starts off with basic information. And then they have to submit certain documents depending on what type of loan that they're going for. And that all gets reviewed, and then we figure out what the best option is for them for financing, and then give them a price range and numbers and go over everything. And then they have a pre-approval letter, which they can then use to put offers on houses. And then from that point, once you get under contract, I mean, the loan process is basically just the underwriting of the loan, conditions being submitted. We need an appraisal, a title search, and then once everything is cleared by underwriting, then we have the money ready, and we just wire it to the attorney.
So what's the current turnaround time right now?
Well, I mean, it depends on the loan program, but I mean, we're typically seeing about 30 to 45 days. Unless someone gets a renovation loan or something that's a little trickier.
A little bit more. Can you run us through what are the core documents that they're absolutely going to need on hand when they start this process?
Sure. So no matter what type of loan that you're getting, you're going to want to have your most recent 1 month of pay stubs available. You're going to want to have at least your last year's W-2, and then 1 month of bank statements.
Does it cost anything for them to go through this process? What does it cost? I know they have, obviously on our end, their closing costs and attorney fees and all this, but is there any costs that go along with them, purchasing a loan per se?
So we never charge anything to borrowers while they're applying. We incur certain expenses like the credit check and running findings and doing verifications.
But you're incurring those.
But we never charge anything. So the borrowers don't actually pay for anything to get pre-approved for a mortgage. The only time that they pay anything is at the closing. Besides, excuse me, they have to pay up front for the appraisal fee.
Okay.
So sometimes we also charge up front for a condo questionnaire fee, but a lot of times we'll just cover that and then charge it at the closing. But the only thing really to expect from the lending side to pay up front is the appraisal fee.
And what is a typical appraisal fee cost nowadays?
It's anywhere from $450 to $600 for a single family, depending on the area. A multifamily appraisal could be $650, $675, depending on.
So it sounds like the bigger the property is, the more there is for them to go over and appraise, then the bigger the price tag becomes.
Yeah, sometimes if it's a bigger property, the appraiser will want a little bit more money. We try to keep them set at a certain amount, but they want more wiggle room. For some reason, Fairfield County is more expensive for everything. So
That's
it's like it goes up
just not appraisals.
instead of 475, it's 600 because it's Fairfield County.
So is a cup of coffee in Fairfield County.
Yeah, pretty much everything's more expensive there.
Oh,
All
brother.
right, so can you tell us what the typical criteria is for getting a mortgage? Like credit score, things like that.
Sure. I mean, it depends on the type of loan. Typically, if you're over a 680 credit score, then you're going to want conventional financing because it's going to make the most sense. I mean, the minimum credit score for conventional is 620, but unless you're doing a 15-year loan that doesn't, price out depending on credit score, it usually makes more sense at that point to go with an FHA loan. So
if you're doing less years, it makes more sense to go FHA?
no,
credit score.
like let's say you have a 640 credit score,
Right.
FHA is going to be pretty much your only option because conventional is going to be super expensive, especially if you have PMI. But if you're doing a 15-year loan and you're doing 20% down, then the conventional loan is still going to be the better option.
Okay.
All right. Do you see an increase in FHA loans getting applied for right now?
Right now, no, actually, we've seen an increase in conventional financing, which is great because conventional loans have kind of eased up the requirements a little bit. Where it used to be 20% down for a multifamily house, now you can only do 5% down, for example.
And that kind of tracks because if you remember the last time in the episode we did, we were talking about like what's happening and who's buying and who's those cash buyers and we were talking about where they're getting that cash from. That makes sense because they have that additional cash to get rid of the PMI and put that 20% down. So that tracks with what we were saying in the other episode.
So you were right.
I think so. I think so. Can we just make a note of that, please, in the husband and wife logbook? She was right. Just saying.
Send them a link to this show.
He's not going to watch it.
Yeah. Next, then we should probably go over what loan types there are out there.
Yeah.
Mike, could you give us kind of a rundown of what's out? I know there's a lot. And there's probably a lot of people don't even know about. So give us the.
I mean, you've got your typical conventional and FHA loans, and then you also have VA for veterans and USDA, which is a little bit less well known, which is only available in certain areas, but that's actually a great loan as well with no down payment and
Yes, please.
very low monthly mortgage insurance. But the type of loan that's very popular right now in Connecticut is the CHFA financing because they have the down payment assistance programs, which is the time to own loan and the DAP loan. And the time to own loan.
Hold up. What does DAP stand for?
DAP stands for Down Payment Assistance Program.
Got that. DAP.
So anybody that qualifies for a CHFA loan can get a DAP loan up to 4% of the purchase price, which covers the down payment and a little bit of closing costs and escrows. So with that loan, you have to have more money. But if you qualify for the time to own loan, they're giving $25,000 with no interest, no payments, and forgiving 10% of it per year until it's gone. So, it's a very attractive loan program because it limits how much money people will need to have and it reduces your monthly payment and it makes it a lot easier to buy a house. But they have a lot of requirements. So that's what I wanted to touch on a little bit is like if you want this $25,000 of free money, like how do you get it?
Go for it. We
So-
would love to hear about free money.
So first you have to qualify for CHFA loan, which CHFA has their own income limits, which the income limit is based on only the borrower's income. So if you have like a husband and wife or boyfriend, girlfriend, whatever, whoever's on the loan, that's whose income counts towards the income limit. It used to be a household income limit, but now you could have two people both making $120,000 a year and just do the loan in one of their names and still get the CHFA loan.
Okay.
So typical household income limit, the income limit for 1 to 2 people in the household is $122,000, and the income limit for 3 or more people is $140,000 typically, except Fairfield County because everything's higher.
Here we are, Fairfield County.
The purchase price limit's $510,000, so you can buy a single or multifamily house up to that purchase price. And the maximum combined loan to value is 105%. So they'll give you a second mortgage up to 105%. So if there's too much money with the $25,000, then we just put more down. Then you could do 5 or 10% down if you need to. So the time to own program, though, to qualify for the full $25,000, you have to be under 80% of the area median income. The other requirements are you have to live in Connecticut for 3 years, and your housing debt ratio has to be at least 30%. And that's a strange requirement. Like, there's no other loan that has like a minimum housing ratio. So, like, if you make, let's say $6,000 a month, but your housing payment has to be at least $1,900 or whatever 30% of that is. So you can't get something too affordable. You have to get something that basically costs a third of your income.
Really good in debt. Like if you're gonna go in debt,
That
do it
is
right.
interesting.
Right.
Yeah, I didn't know that. Yeah.
So that could pay your down payment, closing costs, escrows, realtor fees. If there's some additional buyer agent commission that's due, it could pay for all of that.
Wow.
So it's a really great program if people qualify for it. So it's good to know the basic requirements.
Yeah. All
Thank
right.
you, Mike.
So through the process of getting all of those documentation, that's how you'll determine what product is best for them.
Yeah, exactly. Like when I do the calculation of what their qualifying income is and see what their total income is, like I'll check it against the CHAPA income limits and the AMI guidelines and figure out what type of loan is best for them. So yeah, we would do that at that point. Yep.
Very cool.
So-
Wow, I'm learning a lot. You know
Yeah.
what? So I think it's time. It's time for the big question. It's
Uh-oh.
time for the.
Right.
Let me get Mike's crystal ball.
No. Yeah. No, you said you forgot it today.
It's over here.
Yeah.
Right off camera. Right here.
We're gonna put Mike on the spot, and we're gonna ask the big question: what are the rates right now, and more importantly, what is your prediction for the future?
Yeah, so I mean, going by CHAPA rates, right now it's 6.25 for FHA and 6.625 for conventional, and the rates are definitely coming down. The crystal
Let's
ball
say that
said
again.
so.
Say that again.
Yeah, the rates are definitely coming down.
Hear that, people? Go. Continue.
So
We get people that are still. I do hear people constantly complaining about like, well, I can't sell now that the buy, and the rates are still crazy. And the rates, it's not. They're not. They're just not.
yeah, it's hard to give up a 2.5% rate for a 6.5% rate.
Okay,
Yeah.
we're not talking about 2.5%. Who invited him? Oh.
I hope that happens again. If you need to refinance, let me know.
Yeah. So what is your prediction then for the future? Where do you think it's going to go? 2.5%?
How low will it go?
Yeah.
How low can it go?
I
How
think.
low can it go? What?
Hello, can it go?
Yeah.
I mean, realistically, best case scenario is over the next 2-3 years, we see the rates settle somewhere around 4% or in the 4s.
4% is still good, though.
Yeah,
4%
it's
is
reasonable.
good. Yeah.
I don't think we're going to see 2.5 again,
Yeah.
but I think it's going to definitely settle somewhere a lot more reasonable than 6.5, 7%. You know.
Well, let's hope that happens soon.
Yeah, I think this is the last kind of crazy year. Like,
Yeah.
we'll call it tumultuous. It's one of my favorite words.
That'd be nice.
You know what I mean? Like, I feel like there's kind of a lot of unknowns still, but that's mellowing out.
Yeah.
And I think that's kind of the path we're going to be on. Things are going to get back to normal, and yeah. So, thanks, Mike. We're so
You're
excited
welcome.
you popped
This
in
was
today.
great.
You know what I was thinking? We should, if we haven't scared him away, we should probably have him back and talk about really in depth, like the different loans there are, because he mentioned all those USDA and all that stuff.
Yeah.
Or
There's
even
a-
I got
we
2 more
have-
pages of notes
Oh,
here.
there you go.
Oh.
Yeah.
But of course, get in touch with whatever lender you were working with. They will thoroughly look through everything.
Preferably this
Yes.
thing.
Don't just look at the chart and say, "Oh, yeah,
Yeah, that's
I'm
me."
below them."
Yeah,
No,
no.
you got to talk to someone too.
Yeah,
All right.
that's their job. It's your profession. So.
Yeah.
Thanks again, Mike.
You're welcome.
We will. So we're gonna sign off. We're gonna
Yeah.
say, I'm Fran.
I'm Danielle.
And I'm Mike.